Hello everyone, and welcome to the final video for the month of September covering John's retirement account. Thanks for being patient after our situation I mentioned in the last video. Hopefully baby can be coming home from the NICU soon and that we can all be home together. And that would also be something where I could spend more time working on some videos that I had planned. But I did add some additional insight later on in the slides here. Let me know what you think. I have a feeling that a lot of retirees, or at least people that have questions regarding RMDs, required minimum distributions, will find it pretty interesting. So without further ado, let's jump into the numbers. So I'm not a financial advisor. I don't claim to be one. Article reflects my personal views, and I'm not giving any advice. I always recommend that people do their own research, and also this does not reflect the views or opinions of my employer. I do share a number of positions similar to John's retirement account, and those are listed on this slide as well. And then this is a real portfolio with actual shares being traded. This is not a practice portfolio, and it is not play money. So these are real trades that are taking place. And the big reason why I do this is that years ago, John and Jane were being taken advantage of by their financial advisor, who did not make it clear about some changes that they made. And when they found this, they decided that they wanted to basically manage their own portfolio, and in this process saving them money from what they were paying their advisor, but then also making sure that the way that their investments were handled were those decisions were made by them, so that it can match their lifestyle and do what they wanted it to do. So a lot of what I'm doing with this is I just wanted to be able to challenge conventional thinking about advisors, and I'm not saying that advisors are necessarily bad, but the thing is that is it worth your time to do some things on your own? Do we as individuals have enough information to make it so that we don't have to have an advisor? Are we willing to put in that time to be able to do those things? So I just find it to be an interesting conversation, and I like to get people thinking about these kind of subjects. For John and Jane's background, both of them are retired and collecting Social Security. In addition to Social Security, they draw $1,700 a month from the taxable portfolio, and then $1,000 a month from John's traditional IRA. They do have other investments outside of what I help them with, and those are primarily low-risk bonds and CDs. And they also have no debt or monthly payments. So because they have such limited recurring bills, it does make it a lot simpler to live on the bare minimum amount of distributions if they want to. They could, of course, take a lot more than what they currently are, but that is part of the reason why they only take what they do at this point in time. So the traditional IRA in the month of September generated just under $1,950 of dividend and interest income, and in the same time in 2022 it generated $1,632, so pretty substantial increase year over year. And then the Roth IRA generated just over $965 of dividend and interest income, and that compares with just under $910 for the same time in 2022. So both saw a pretty modest increase there. One thing that has performed well, at least comparatively, with September of 2022 is the account balances. So the traditional IRA at the end of September had just over $333,000 balance, and that compares with the $324,000 balance in September of 2022. And then the Roth IRA had a balance of just over $202,000, and that compares with a balance of $191,000 in September of 2022. There were a total of 3 companies that paid an increased dividend or a special dividend during the month of September, and no companies in the portfolio decreased their payouts. So the three companies, BP is the first one that is shared between John and Jane's portfolios. So they had given a 10% increase during the month of September. And then for Duke Energy, they gave a small increase of 2% in the month of September. And then for Main Street Capital, they also share that between their portfolios. They provide a supplemental dividend, or a special dividend, if you want to call it that, of 27.5 cents a share. So in this case, I've mentioned that BP stock is looking a little bit more compelling after its Q3 earnings miss. So even though things didn't necessarily go as well as they could have on that report, I think that it is creating a buying opportunity, especially among other major energy producers that are currently selling at, in some cases, close to their 52-week highs. Duke Energy's dividend increase wasn't very compelling. If you look at the historical numbers for it, it hasn't been that compelling over the last several years. But given that the company's stock price has come down, it is currently trading below its 15-year PE ratio of 17.13, and it's currently close to about 16 times. So that does make it at least a little bit attractive there. But we've been seeing utility companies' stock prices coming down. A lot of that has to do with the risk-free rate and being able to invest in things like CDs, and the way that interest rates are going up. Utilities have been particularly hammered by that. So when it comes to the dividend, I'm not going to say jump all in and buy, Duke stock, which I believe is yielding like 4.7% or somewhere in that neighborhood. But from a long-term perspective, if you're willing to hold that investment for a while, there is at least some upside. Given the cost basis that you'll see here in just a minute, we're looking for that price to drop lower before we add anything, just due to the existing size of the position and what our cost basis is. So for BP, one of the things that I'm going to add on articles moving forward is in the lot details. I'm going to show basically how long dividends have been collected for. And, interestingly enough, I just noticed this, that the dividends for me, I can only go back, even if I do a full search, I can only go back so many years. So in this case, you can see that the position was opened way back in 2017. But in this case, the dividends, the furthest back I could get it to, is basically 4 years. So in the 4 years here, John and Jane have collected $1,279.10 of dividends from BP. And I say John and Jane, but specifically I'm speaking about John's holding of BP. So that's how much in dividend income. And part of the reason why I wanted to show that is to show that with the gain loss that we see here, we are actually still sitting at a positive. If we sold this position today, the holding of BP has still been a net positive in terms of the dividends that have been received relative to the loss that would be taken if the shares were sold. So not necessarily anything earth-shattering, but at least I think an interesting concept to think about. And then for Duke Energy, you can see here that not only are they sitting at a pretty strong gain, but in addition to that, since 2019 in December, they've collected $2,701.74 of dividends from Duke. So basically, if you look at this, you can say that this gain loss here, that if we were to take the dividends from since that time and then also the gain loss, add those two together, and we'd be sitting at close to about a 40% gain if you're factoring in what has been earned from the dividends. And then from Maine, you can see here that they have earned since November 15th of 2019 a whopping $4,519.30. So in addition to the 17% capital gains that they would have here, if we added this in, that would basically triple this number. And so at triple, that would be over 50% of a gain. So Maine has performed extremely well, and that does include its supplemental dividends that they've been paying out on a regular basis, but also doesn't go back all the way to when the position was first established. Again, that's just the furthest back that the system would let me go, without me having to actually pull up actual account statements. And sorry, but I'm just not gonna start digging through PDF files to try and find the rest of those numbers. So for September in the traditional IRA, there was a couple of buys, but a number of large sales, and a lot of this here was just reducing the size of certain positions, but also eliminating AGNCO. So that's the preferred Series E, and in this case, I'm looking at the fact that at the yield that it is, and with the way that rates appear to continue to be going, this just doesn't make sense to hold from on a long-term basis anymore. I just don't. I'm just more interested in selling it off and putting the money into a CD and letting that CD generate 5.5% without the volatility that's associated right now with preferred shares of higher yielding companies. So, the purchase of Crown Castle has paid off and nicely in the last few days. We did buy a few more shares of WP Carey after the announcement of its dividend cut, and then the spin-off that it has of, I believe it was Net Lease Properties. We're still waiting to see kind of where things fall with WP Carey before we continue adding more. But I think that there is just a lot of negative sentiment that's come out about WP Carey, when in fact I'm gonna go with management's track record of making wise moves, and in this case I still think that WP Carey, that it's in their best interest to have done something like this, because their dividend increases that they've been giving just really aren't compelling. And so being that we have a pretty low cost basis position, their portfolio after the spinoff, will have, it'll be a much more stable group. So I think that there's potential opportunity in the future with WP Carey, even though there's some people right now who are saying they slashed their dividends, so sell the company. I don't necessarily believe in that. With Oshkosh, we didn't have much of a position left with them, but after the stock price moved up the way that it did, we decided to sell it. Because the upside I feel is fairly limited. I mean, the stock price right now is still about where it was when it was sold, and it's been a month and a half. So I just don't see much more of an upside for Oshkosh at this point in time. I would consider buying more shares if the stock price drops below the $80 share range, but I don't think that's going to happen, because it looks like some of their inventory backlog issues are being resolved, and that seems part of the reason why their stock price has gone back up again. And then for Valero Energy, we were lucky enough to have sold that one off basically when the stock price pushed up to its peak. So if you look at the history of Valero, anytime it reaches about $140 a share is a good time to trim back the positions that we have, especially if we're reallocating into other areas of the portfolio. $140 a share. Just there's not a lot of upside left once it gets up to there. So that's one of the big reasons why you see the sale there. Stock is currently selling at just under $127 a share. So that was a great time to have reduced the size of that position. And then for the Roth IRA, we went ahead and eliminated Rhythm Capital, going back to the same concept for what the yield is, and then where rates appear to be going. It's just not something we would rather hold certificates. We'd rather hold more stable investments than what we have with the preferred stocks right now. So preferred stocks, there's a lot of cons in a rising interest rate environment, and so getting these ones off the books is just a better approach. It's a safer approach. So, and then when it comes to UTF, that was us basically capitalizing on what has been just the hammering of the utility sector that I mentioned. The thing is, though, now that we've had some optimism in the last few days, we have seen a pretty steep rise in the value or in the share price of UTF. So luckily we were able to buy some shares when we did, and now that we have those in there, if UTF's price goes up enough, then we'll be able to cut back some of our higher cost positions and recycle that capital like we always do. So for the traditional IRA, the realized gain loss, because we only had the 3 trades that took place there, I was able to actually include those on this screenshot. So you can see with Oshkosh, we were able to make a decent amount of gain on that, and that's because we had gotten in a low cost position. I can't remember exactly what the number was off the top of my head, but I think it worked out to be close to about $80 to $83 a share, somewhere in there. So that worked out well. And then for AGNCO, you can see that for the size of the position that we had, I mean, we basically sold it at a break even. And again, it's just safer now, being able to put those funds into something like a certificate or something like that. The stock is that preferred shares is now currently trading at about 50 cents less per share. So if you took that, the loss, had we sold today, would have been substantially higher than what we did sell it for. So, and then Valero Energy, you can see that for our cost basis here, we're walking away with about double, and that's just because we've spent a lot of time accumulating an extremely low cost basis for Valero Energy. And then for the Roth IRA, same thing with Rhythm Capital here. We were able to basically sell it at pretty much a break even. So that was, as far as timing goes, that was the big reason why we were willing to eliminate both of those preferred share positions. And then when we look at the year-to-date traditional IRA and Roth numbers, so this is through November 15th, and you can see that we've basically taken a net gain of about $7,000 on the traditional IRA, and then on the Roth IRA, there's been a gain of about $4,000. And the big reason why I want to show you this is because when we get to the other screen that shows the current gain loss, and you're looking at something and it shows it's a loss, one of the things that someone can do is sell off shares and take losses and hide those losses by not showing the gain loss screen. So in this case, if you see that we're currently sitting at losses, but then you see that we've taken gains here, if it wasn't something where you saw that we had a net gain here and you saw we had losses and then I'm sitting at losses in the gain loss screens that I show you later on in the video, then that would tell you that something's really going wrong, because if I'm selling things at a loss and then I'm still sitting at losses, that's kind of like a double whammy. Whereas in this case, you're actually seeing that part of the reason why the losses are where they are today is because we have sold off shares and actually taken those gains off the table. And taking gains off the table can exacerbate or at least show what looks like losses that might have been worse than what they really are. So anyway, I just think it's really important to be able to see these screens, and also to know that we're not hiding those numbers within this, to make it look like the performance is better than what it really is. Because when times, if things were to improve and those gain loss screens were to turn into the positive, and then you see these turn to the negative, it could be that we sold off all the losers, took a whole bunch of losses, and now it looks like we're crushing it with our portfolio. So that's just a big reason why I think that screen's important. So for September, the traditional IRA comparison, AGNCO was eliminated. Avista Income has more than tripled. We've increased the size of that position pretty substantially. Avista is our local utility company, and given what their yield is and where their stock price is and the service they provide, I think it's a good utility company. And then for CCI, income has doubled from the increase in the size of that position. And then with Pepsi, we reduced the size of that position, and part of that had to do with the stock price having reached a point that I just did not see further upside. So given what the yield was, which right now the yield on the shares is just over about 3%, there wasn't a lot of upside remaining from what I can see. And Pepsi is a very low cost position. I think it's close to about $100 a share, somewhere in that ballpark. So anyway, that was the reason why we did that. But with Valero, that position was reduced, but it still remains a substantial size, or amount of the portfolio, I should say. So with Valero, just looking at my gain loss screen, it still makes up 22,000 of the portfolio. So it's actually just under about 7% of the traditional IRA. So even though we sold off those shares, it is a primary holding in this portfolio. And then for the Roth comparison, so from Apple Hospitality, just like the previous month when we mentioned this, the dividends continue to grow, and we actually had just recently reduced some of the high cost shares. So as the stock price moved up, we felt it was at a point where we could take the small loss associated with selling those shares. So we have reduced the size of that position slightly, but it was to eliminate some pretty high cost shares where the stock price has not been that high since prior to COVID, and that is darn near going on 4 years, almost 4 years ago. So and then EAFAX position is the same, but because of the rising rates, the dividend has increased, or I guess you could call it distribution has increased pretty substantially. And then with the Prologis, we decided to nibble at some shares here after the stock price dropped to its 52-week lows. And then also with PNW, the utility company for the Arizona area, like the Phoenix area, we eliminated that position, and that was because the stock price reached, I believe it was about $78 a share that we had sold at, and that'll be reflected in, I believe it's next month's article, or in the month of October was when that was sold. I can't remember exactly off the top of my head, but when it reached about $78 a share, with what was happening to utility companies, it made sense to eliminate that position and wait until the stock price got more attractive again, if we were going to add or build it back up again. And then increase the size of UTF holdings, and that one is especially as utility stock prices have fallen. That's why we recently added some there, so that now we can start to eliminate some of our higher cost UTF shares. And then the year-over-year full income comparison. So 6.3% increase in the traditional IRA dividends, and that's improved from, negative 6.3%. So the traditional IRA is estimated to produce 6.3% less dividend and interest income than it did in 2022, and that is improved from August, which was going to be negative 7.6%. So we that substantial increase in income was greater than what our estimates were, and that's what brought that down. And one thing that isn't being reflected on here as well too is the certificates of deposit and the interest income that comes from that. I do not have that factored into these yellow numbers here, because there's just too many variables right now. So I try to always err on the side of safety instead of making it, instead of this number adjusting for the worse, I'd rather see it adjust for the better. And then as far as the Roth IRA goes, this one, the portfolio produced slightly less income than what was expected. Some of that's going to be the timing from having sold shares, and then the income being produced from certificates of deposit, but nothing that I would be concerned about at all. And because it was just down slightly from 16.3% in August down to the 16.1%. And then the account balance comparison. So we've seen price or account balances retreat / I would say recently kind of hold steady. But when you look at September of 2022, the markets were particularly volatile during that period of time, which is part of the reason why the account balances look so good right now relative to what they were. But I'm going to take that with a grain of salt, because as you can see in the months of October and then November, everything, improved substantially. So we'll wait and see what those numbers look like. But I don't think that things improved in October of 2023 substantially enough to keep up with what change happened in 2022. One thing I do like to factor in is that with John's traditional IRA, because he's taking $1,000 a month of withdrawals, that the balance would have hypothetically been another $12,000 more than what you currently see here, so about $345,000. So basically, the disparity would be about $21,000. Compared to the about $9,000 that you currently see. So just to factor in that money that's being drawn out, that it even outperformed in the month of September in the traditional IRA, even with having removed the $12,000 between that time for his withdrawals. And then for the 6-year review, you can see that, and again, back when we started in 2018, this isn't perfect because obviously we had just started the portfolio, but you can see that it's been a continuous step up with a slight setback in 2021. And then 2022 and then 2023. So, this will actually be the first year that we probably end at a slight negative. And part of the reason for that is actually because of how much of an increase occurred in 2022. And that's going to be largely related to this guy right here. The $3,733.73. That was Healthcare Trust of America, and then being bought out by Healthcare Realty Trust. So that's going to be something that skews these numbers a little bit and makes it look like it didn't produce as much income this year, when in fact it just produced a lot of income this year because there was a huge special dividend that was paid out, and that was covered in the previous article, or the previous video for the month of July. And then for the Roth IRA, you can see here, again, it's been a steady increase all the way through, with the exception of 2020 here. There was a couple of companies here, EPR being one of them, that had its dividend, if I remember right, I believe it was cut entirely for a while there. So that was the big setback here, but then you can see that now it's back on track for a growth trajectory. So here we can see that the loss there, but since then it's been growing steadily. And then the cash balances, so this does not reflect investments in CDs and money markets. John currently has $45,000 in CDs between the traditional and Roth IRA, and then as of November 14th, had about $40,500 of cash on hand between the two accounts. And then there's a delay between the cash on hand that you see in these tables here, why they're so high, and then what you're seeing in this information here. And a lot of that does have to do with having invested some of that money into CDs. And hopefully, as I get these videos caught up, that delay won't be won't be as large, because in this case, obviously, it looks like John has a lot more cash on hand than he currently does, because he did have that money at the end of September. So for the gain loss, we can see that both accounts are in the red at the moment. This will be the first year since 2020 that I think we're going to see the Roth IRA end in the red like this, just based on how long it's been in the red here. And the traditional IRA, it's possible it'll end up in the black. Honestly, though, this isn't really something that, I shouldn't say I don't really care, but it's really only something that I would care about if I had concerns about the quality of the portfolio. And that kind of goes back to some of the trades that we made in terms of selling off, AGNC Preferred Series E, and then Rhythm Capital Preferred Series, I think it was D. Part of the reason why we sold those off is to have more stable investments. But the remaining stocks, as long as these are companies that continue paying out dividends and that their operations are going well, then frankly, the generation of income to us matters significantly more than whether or not we're seeing a loss. Because as you can see, during 2020, we've experienced potential losses, unrealized losses that were far greater than anything that we're looking at today. And that goes for both the traditional and the Roth IRAs. So this is just an idea of, I show this screen to help people understand, get used to volatility. This is not the part that should scare you, unless you're concerned about the holdings that you have. If you're invested in a bunch of real estate investment trusts that are mortgage REITs and things like that, well, yeah, that's gonna be something I would be far more concerned about, dividends being cut and things like that. But if you're owning, quality companies like Pepsi and things like that, you can tolerate, some of this negative, the potential of unrealized losses, because that's not the part that you should care about as long as the income is being produced. So for the traditional IRA, this was one of the things I mentioned at the beginning of the video, that I think that people will find interesting, to better understand how a required minimum distribution works for someone that is needing to take withdrawals in order to satisfy federal, the IRS, I guess. So in this case, John's receiving $1,000 a month, even though his IRA could be providing him with $1,370 a month. And with RMDs, The biggest thing about dividend investing is that your goal is to be able to cover that RMD as long as possible without needing to sell shares, because needing to sell shares leads to you potentially having to sell something at a discount or sell it at a price that you don't want to. But also, once you've sold it and eliminated it from your portfolio has a chance of producing less income next year simply because you don't have the same amount of money invested. So the longer your cash flows are able to cover the RMD, the better off you're going to be. And that's something I think I'm going to really try and drill home in these articles. I'm sorry, I'm never going to get over saying articles after all the writing on Seeking Alpha, but in these videos. So one of the things is that there's calculators available online. The one I used was from Charles Schwab. And so you would use the 2022 year-end balance of $352,000. And that tells us that John is going to be required to withdraw $14,111.48 to meet his RMD. So this would approximately be $1,176 a month. So basically what's going to end up happening is we're going to end up doing a catch-up withdrawal at the end of the year for $2,111.48 in order to make sure that John meets the withdrawals that he needs. But the beautiful part is that our amount of income, the $1,370 a month that's currently being generated, is more than enough to cover the $1,176 a month that this $14,111.48 averages out to be. So on on here, this is a screen with a lot of stuff going on, and I get that. But I like to, this is the screen that allows me to be as transparent as I can possibly be at this current point in time. So in the portfolio, we're sitting at losses in some of these. So we're sitting at huge gains like in Valero, but we're sitting at losses in a number of these other positions. And this is part of the reason why we focus so much on reducing our high cost positions, because that just is, it's good practice for rotating capital and being able to potentially lock in lower cost shares, which means that during a downturn or during bad times, that there's less exposure to this potential downside of unrealized losses. Okay, so in this case, there's no tax consequences for selling shares. So part of the reason why we're willing to sell off positions like Valero here is that until John takes a withdrawal, in this case, the $1,000 a month that he takes, that's when the funds that he takes are considered a taxable event. So we can sell this off. Now, if we were to sell off some of these ones that are losers, unlike the taxable account, we can't count those against our gains that we get. And so, part of the reason why my goal is to not sell some of these ones that are temporarily sitting at losses like this is that, frankly, there's no taxable benefit for doing so. So it all goes back to, do I have concerns about the company and its ability to do what it needs to do? And a good example is going to be PacWest Bancorp. It's sitting at a pretty substantial loss, and frankly, right now, they're not doing so hot. It's not so much that I'm keeping this because I think that there's a lot of potential upside. It's that I want to wait for their merger with Bank of California, I believe it is, before we make any decisions about whether or not this needs to be a company that remains in the portfolio. But PacWest Bancorp is definitely a loser on this list. And then for the Roth IRA, same thing here, except for even when you draw funds from a Roth IRA, there is no taxable event. So John right now could potentially withdraw, let's just say sell everything and withdraw all $207,000 that's in this account, and it wouldn't he wouldn't be taxed on any of it. So the disadvantage of obviously doing that is that then you have $207,000 that if you invest in something, and because it would be in the taxable account, basically you'd then be taxed on it. So in this case, they've elected to not draw from the Roth because there is no RMD, required minimum distribution. But that's part of the reason why the Roths are so beneficial, is that you can let this money sit in here forever, and it doesn't matter. So this is also the kind of portfolio where I'm much more comfortable holding preferred series shares, because with the RMD, if we had to sell, for example, some of these preferred series shares, if they're sitting at a substantial loss, well, an RMD doesn't care about your substantial loss. So with a Roth IRA, because there is no RMD, there never comes a point where we'd be forced to sell these shares unless we chose to sell these shares. Hopefully that makes sense for everyone. So here's some conclusions to end with. So expect to see cash balances increase, and by cash balances, I also mean the amount of money that is being invested into certificates of deposit. The current gain loss tables are on the previous two slides, are current through November 14th. And so when you compare those with the previous tables were based on September month-end reports from Charles Schwab. So I just like to make it clear that that's why you see such a disparity between those two things, because you're talking about a month and a half difference. Again, as these videos get caught up, that'll become less and less of an issue. And then for tax-deferred accounts, like IRAs, there's no impact on John and Jane's taxable income when trades are made, because it's only until the funds are drawn from a traditional IRA that it actually turns into a taxable event. So that's a really important thing to consider, and part of the reason why we're willing to do more sales in these accounts than we are from the taxable account. And then John's going to require a little over $2,000 withdrawal from his traditional IRA to meet his RMD. And so the RMD, there's tons of calculators online if you're ever wondering how much you need to draw, but the RMD is going to be based on the number or how old the person is and what the account balance is. So if your account balance goes up and then your age goes up, your withdrawal amount is going to be higher the next year. But if John's account balance is down in comparison to what it was in December 31st of 2022, it is possible that next year he will, be pulling the same amount or even potentially less of an amount, even though his age increased. So if there's any questions about that, feel free to let me know in the comments. And then I just think it's important to remind everyone that a successful dividend income portfolio will generate as much free cash flow as possible to cover the RMD as long as possible. The absolute number one goal is that you should not need to sell shares unless it's absolutely necessary. Selling shares is basically the fastest way or the highest risk way of operating a portfolio, because say for instance, if all these investments were in companies like Amazon that don't pay a dividend, or even at least in companies like Apple that have a really low dividend yield, there would come a point where in order to meet your RMD, you would be required to sell those shares. Well, Amazon, not that long ago, had been trading at a substantial discount to what shares had previously been going for. Well, what if you had to meet your RMD for the year and now all of a sudden you have to sell off a bunch of Amazon shares because you don't have the cash flow to meet it? So that's kind of why dividend investing is so attractive. And from my perspective, when someone gets to a retirement age, is that they're not looking to make it big by investing in Amazon, at least not substantially, and becoming millionaires. That's not John and Jane's goal. John and Jane's goal is to generate income so that they can live a comfortable retirement. That's really what it boils down to. So, anyway, if anyone would like me to elaborate more on some of these topics in the next video, I know I've already gone long on this video trying to cover some of these things, but hopefully this additional discussion around retirement accounts and things like that is considered to be useful. So thanks everyone for watching. I appreciate the people that have been watching and leaving comments for me to answer. It's kind of fun to see it get back to a number of subscribers that is making me feel like kind of like what I had on Seeking Alpha in a way, because as I've mentioned before, it was kind of hard to go from having that many subscribers and regular watchers. So anyway, thanks everyone. Appreciate your time and have a great rest of your day.